Good morning, ladies and gentlemen. This is Clueless 8, and this is the pre-market AM report for another exciting day about to begin for July 7th, 2015. Today, on this early AM report, I'm going to quickly cover some critical technicals that are being played out in the markets right now. So let's start off with the E-minis, which, as you all know, are the proxy for the S&P 500, the futures market with the fast money moves, and they're not always right, that's for sure, but they certainly need to be monitored very closely for especially for active traders, intraday traders, as well as swing traders and people, investors alike, who want to know how the technicals in the market work. There's an old saying that technicals precede fundamentals, and in this particular juncture of the market that we're in, that is very, very true. Now, here is an hourly chart on the E-minis. We have a definitive pattern so far. And again, I want to remind everyone very clearly that volatility is rampant. If traders are looking for sure things, there are none. You have to be active. You have to monitor. You cannot just leave a trade that you're looking to get out that same day in place and come back and say, hey, why didn't it go there? Patterns are changing almost every hour. However, the broader pattern is starting to take shape. So here's the bottom line. For swing traders, I believe that we have some levels that we can project and patiently and with discipline and with courage, I should say, hold on to and take profits as it gets there. But for active traders who are looking at their P&Ls every nanosecond, I can assure you that this market will throw more curveballs at you and take you out of your trade, long or short. And so I warn everyone that if you're looking to swing a trade, then there are certain levels that I'll be showing, which I think we will, and I have showed yesterday on yesterday's videocast too, and constantly on the Twitter real-time feed, that we're going to, such as S&P 500 3450 moving average, day moving average, as well as the 2100 level, where it looks like it's a magnet, and from there we'll see what happens. So that's fine. That's still intact. For shorter term traders, you have to basically, you know, uh, 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 monitor very closely, as well as follow the real-time Twitter feeds. As you saw clearly yesterday, we were long, we were short, and it worked. It worked out in both ways. Okay, so here we are. So let me get my drawing tool out, as I normally do, and show you something here. You have, looks like there's a double bottom in place right now. So you have one here and you have one here. Okay, this is turning out to be what they call a dragon bullish or a W pattern. And at this point in time, if we take out this downtrend line that we can see here, that's been drawn from 2 Wednesdays ago, then we are looking at a move up to complete the pattern at around the 2120 level, which is on the E-minis, 2120, which I believe is around 2125 or 2126 on the S&P 500. Now, in order to get there, it's not going to be a simple process. One of the things I talked about very in detail in last night's advanced coaching session with a couple of our members is that when you see this type of moves, when you see this pattern symmetry, it's not a linear move. It's not a linear move. This is not a straight line down. Okay? This is the way it happens. This is what throws traders off. This is what drives them nuts. So if you understand the broader picture, then you can stay in the trade or leave the trade. Remember, the ultimate decision is yours. It's not mine. I will provide all the tools. I will provide some very specialized guidance on what I think is going to happen with the market. And the key word is I think. I am just a quicker messenger on the markets. I do not control the markets. So volatility is something you'll have to learn how to embrace. It is not easy. Okay, it is just what life is all about. Life is all about volatility. To attack every situation that comes our way, look for a way to resolve it, attack it. Sometimes you retrench. Sometimes you attack. That's just the way life is. Okay, it's a battle. The biggest battle of life is every day. It's not the battles in life we face every day. It's not the battles that we fight out there. So bottom line is, this is not a linear move. There's a lot of chop involved even on the way down. Okay, so it's not like you can short here and just go away to sleep and say, okay, I'm going to cover my short here. The same thing applies. The same thing applies. Pattern symmetry on the way up. So at this point, we're doing this. Okay. Now this is a minor bull flag here, and once we break out of this level, if we do, and it looks likely we are, based on what I'm seeing here on the internals, and the simplest way to look at the internals is looking at the fast stochastics. And I use the fast stochastics because it's a fast market. It's really as simple as that. And we are oversold, but then oversold can remain oversold. Okay, just remember that. So we have to watch this very carefully. This is a 1 hour chart. If you look at the 4 hour chart, it's going to show you a little different level. But anyway, you can do that yourself by moving the time frames around. You can look at 1 hour, you can look at 30 minutes. 4 hour and daily are good ones to look at, and I'll show the daily from a swing perspective. So again, it looks like we are going to climb up here, one with the other. And of course, the macro news that's coming, like hitting us like a ton of bricks every hour, every couple of I should say almost every hour. Right now on the Greek side, the China thing is kind of on the back burner, even though the Chinese market is in complete meltage, and that is the real bubble, as I keep on pointing out to everyone. Anyway, so we are going to climb up here, and it's going to go like this. Okay, so as long as you're starting to see the longer term, the daily and the 4 hour stochastic start to turn up, I believe that you should stay in the trade. Now, if you're going to be taking in nice profits along the way, let's say there's a move out real fast out of the gate, meaning out of this downtrend line, then feel free to do so. Managing your own trades, managing your own book is key. You cannot rely on others to manage your book. And I've been very strong about this, and I'm very particular about this. I do not rely, and I've subscribed to enough newsletters and have followed a lot of people, and that's fine. I still do. Okay, there's a lot of great minds out there. Great minds. Everyone's got a different way of looking at things. My way of looking at things is very unorthodox, unique. I mix in a lot of global macroeconomic game theory stuff in there, and I look at the fishbowl from the outside in. 99% of traders and investors here in the U.S. look at the markets from a fishbowl from the inside out. Now visualize that for a minute. If you look at the fishbowl from the outside in, it's a different view than if you're looking at the fishbowl from the inside out. Okay, blink your eye for a second and think about it, all right? And if you can figure that out, then you'll understand why my service, which started on April 15, 2014, has been a resounding success overall through hard work, and we're still in the process of evolution and growing, and why my forecasts have been so correct in a majority of the instances. Now, how we manage the trades along the way, that's something I cannot teach. I mean, I cannot really micromanage. So anyway, so the bottom line is that this is the way it's going to go. All right, this is the way it's going to go. The other scenario is that we are going to, I'm going to get this line. The other scenario is that there's a gap here. Okay, there's obviously a large gap here, and the upper end of the gap is here, 2090. The other scenario is we close this gap and we fail. And if we fail, it's going to be a sharp move down. It's very, very possible that the 2030 bottom on the ES that was created early, that was created on Sunday evening, will hold. That's my opinion. Okay, for now. So keep in mind that this gap fill up at the 2090 level, which is around 2096 or so on the S&P, should be, will be met by a huge resistance. No question about it. All right. So, and there'll be sellers at that point. And you know why? It's quite simple. Because a lot of people who were caught and trapped here and the market gap down didn't manage to get out here. Okay. They're trapped. So once they get up there, they want to go out even. They want to come out even and say, oh my God, that's a godsend that this happened. And guess what? That's what a resistance is all about. Once we break out through resistance, new buyers attack the market and the market goes higher. It's just the way it works. That's the resistance and support levels we're talking about. That's the human quotient or emotional quotient of what resistance and support are all about. So let's see here. I'm going to switch this over, and you can see what's going on the daily charts. Now I'm going to pull up the S&P 500, and this is what we're seeing here on the S&P 500 on the daily. All right. So at this point in time, these stochastics are telling us that there's going to be choppiness here. Yes, we seem to have formed a nice bottom, a double bottom here on the stochastics, showing that the worst of the panic might be over. Okay, and it looks certainly likely based on the sentiment indicators, some of them that I'm going to put up on this pre-market AM report. I want everyone to look at it. We have very low bullish participation, a feeling, and we have all kinds of other metrics showing a very low number of bulls. Markets don't create another 1,000 point leg down. Hey, it might, okay, but they generally don't do that from this low levels of participation and emotional what should I say, emotional reading. All right. And but keep in mind here, and I mentioned this to my advanced coaching members yesterday, that this market is driven almost 99%, forget 90%, by machines, by algos and high frequency trading programs. There is very low to non-existent participation by individual investors who are trading the market at this point. Of course there are, but very low. So the bottom line is that what markets are doing, they're doing it on a technical basis. So if technical levels give out, and that's the reason why my service is so particular about understanding the broader picture, the indices, then you can manage your trades better. The trades I'm giving every day, and in between, some of those trades are working out fantastically well. So the point is that if you understand the broader picture, then you'll be able to manage your trades better and keep a lot of money in your pocket, period, long or short. Just remember that. So let's hit this thing here. So we have a powerful bottom here on the S&P at around, let's say 30, and we got there. Okay, so we got there yesterday, and then we bounced. So at this point, attacking the 34, that's 2101, that's a 3450 moving average, which is still seems to be moving sideways, which is a good sign. And if you take and people who have taken the advanced coaching sessions with me, I've explained that you have to study the 3450 and its shape and a direction, to understand why a lot of false breakdowns or false breakouts happen. In this case, a breakdown. We don't know if it's false yet. Okay, so this is the level, the line in the sand around 2030 S&P, and then this is where we are right now. So this candle, if it shoots up, is going to attack the bottom end of this uptrend line, which it broke. So somewhere between 2090 and 2101, the market wants to go to. Okay, just wanted to pass it on to you guys, and that's exactly what I showed on the hourly charts. So once it gets there, we'll see how it reacts. If it fails, then we're going to make a move down here, and it's possible that breaks. If that breaks, this is the next level of support that comes in. That's obviously a much lower level of support, right? That's below 2000, and it's around basically around 1980 or so. So you're talking about a nice 400-point drop type of thing, scenario on the Dow Jones, which I've shown repeatedly on my very precise charts on the Twitter feed. And again, a very powerful reminder: study every single comment, every single chart specifically on the Twitter real-time feed. If you don't have time during the day, do it after work, because that's the only way you're going to survive these markets, okay, and make money. We are. So that's the bottom line here. We are not fully. There is going to be one more flush, I believe, and one has to be quick on that. But at this point, don't wait for a unidirectional move, because the market is still absorbing a significant amount of margin calls, which needs to be sold off in order to satisfy the margin clerks. Okay, just keep that in mind. Oil itself dropping 8% or something crazy yesterday is generating significant amount of institutional margin calls that need to be met. So what do? It's the same old story. They go out there, they sell the rest of their peripheral stuff in their portfolios, whether it be the price lines or this or that, in order to come up with the money to satisfy the margin calls. So one big asset class, when it sells off like that, it really doesn't say much about the global economy. Trust me when I tell you that at this point. All right, Greece itself is not the reason why the drawdown in the oil thing. China could be part of the reason, because of the craziness that's happening out there. That if they truly slow down and slam the brakes, then obviously that's going to be negative for oil and lower, which is a very big positive for the U.S. economy, mind you. That's it for today. join the advanced coaching sessions. That's all I got to say. Have a great day.